going to start with Chapter 5. Again, if you guys have questions on anything that we're talking about, please stop me because I want this to make sense for you guys, okay? This week we talk about accounts receivable. We know that we record an accounts receivable when we've provided a service or products, but in exchange for cash, we have not received the cash yet. Sometimes we call it a credit sale. Credit sales are when we've provided a product or a service to a customer and we expect to collect cash in the very near future. We can also call this sales on accounts or services on account. This is very common in many businesses. The problem with this, guys, is sometimes you don't get paid. Okay? So we're expecting to get this money, but the negative in terms of accounts receivable is chances are you're not going to collect 100% of it. Okay? Accounts receivable is cash owed to the company by its customers from the sales or services that are on account. We record this transaction at the point that we've delivered the services or the goods. Some people can also call it trade receivables. We're going to call it accounts receivable. It's an asset. It's a current asset. So here is an example of recording a credit sale. Lynx Dental charges $500 for teeth whitening. Dee decides to have her teeth whitened on March 1st, but doesn't pay cash at the time of the service. She promises to pay the $500 whitening fee to Lynx by March 31st. So on March 1st, she got her teeth whitened, and it's at that time that Lynx Dental will record a debit to accounts receivable for $500 and a credit for service revenue. That's when the services took place. That's when the revenue is recorded. Okay? Companies record an asset, which is the accounts receivable, and a revenue when they sell the products or services to their customers on account, with the hopes of getting paid in the future. Non-trade receivables are those that are one-time types of events. Receivables that originate from sources other than customers. Tax refund claims, interest, I shouldn't say one-time events, but that do not relate to the sale from customers. Interest receivable, loans by the company to other entities. So there may be other types of receivables that we're going to discuss lightly today, but we're going to really focus on our accounts receivable. A note receivable is another form of a receivable, but this is shown by a written agreement. A note receivable will have a signed agreement showing who the parties are, how much is owed, what the interest rate is, the dates, the terms. Which of the following are sometimes called trade receivables? Hey, excellent, guys. So, for the most part, we provide a service. When the service has been completed, we report the income along with either the asset cash or accounts receivable. But sometimes companies like to confuse it up and make it a little more complicated. Oftentimes companies offer discounts and guarantees that reduce the amount of cash the company is going to receive. Sometimes we call them trade discounts. We're going to talk about what a trade discount is. Sales returns, it's when you return an item. Sales allowances and sales discounts. So we're going to talk about all these different items that may reduce what we're actually going to receive from the company. Know that our revenues are going to equal our total revenues minus any of these returns or allowances or discounts. A trade discount is a reduction in the list price of a product or service. It's used to provide incentives to larger customers or consumer groups to purchase from a company. Since sellers are entitled to receive only the discounted amount, the sale is recorded at this lower amount. Here's a great example of this. Say, for example, I'm going to purchase a cruise, but for teachers, they give it to you at 20% off. Well, they're going to just record the cruise at, say it was regularly $2,000, 20% off, $1,600. They're going to show that sale of $1,600. Got it? I look at a trade discount similar to going into a store. I was at the outlet in Eagan yesterday, and they have a price, but then they say 25% off this item. Okay? So am I going to pay that price that's on the tag, or will I get a 25% reduction? That's the amount the store is going to show, is what they've shown as the sale price. A trade discount is similar to like a sales price. I typically provides laser eye surgery for $3,000. But the company's offering laser eye surgery in the month of March for only $2,400. So if a customer gets laser eye surgery, the FEI is only going to show accounts receivable for $2,400 and the revenue for $2,400. Does that make sense? Trade discount is like a sale. Now, sales returns and allowances are a little different. Sales returns and allowances means the sale has occurred. But sometimes a customer, due to various reasons, will return goods or maybe are dissatisfied with a product. In this case, though, we do record it because originally we showed the full amount. And then if a customer returns goods, that's going to be called a sales return. A sales allowance is a little different. With a sales allowance, the customer does not return the good, but somehow they're not happy with it. And so as a result, the person who sold those goods, the seller, might issue some kind of special deal. So know with a sales return that when the customer returns the good, the seller either issues cash or, if it was done on account, reduces the accounts receivable. For a sales allowance, the seller is going to either issue some cash or reduce the accounts payable. For example, a sales allowance might work if someone orders a certain color tile for their house and they agree to pay a certain amount. And when the tile gets delivered, it's a shade off. They're not happy with it. It's not quite what they ordered, but they'll take it. And oftentimes the seller, to make them satisfied, will give them a discount because things weren't perfect. Does it make sense? Those items do get recorded because remember, the original agreement happened and then it's being adjusted after the fact. If on March 2nd, FYI sells sunglasses to one of its customers for $200 on account, on March 4th, the customer decides she doesn't want eyeglasses and receives the full refund from FYI. If this is the case, think about on March 2nd, they debited accounts receivable, they credited sales revenue, right? But if the company receives back those items, they will report in their books a debit to sales returns and a credit to accounts receivable. So it's going to wipe out the receivable. But do you see we don't debit sales revenue? Do you see how we're debiting something else called a sales return? So we can keep track of how many times this happens. Don't we want to know why this is happening? Okay? So you notice here, sales revenue is not being debited. We have a sales return that is being debited. Here's another type of what we call a sales allowance. The customer having laser eye surgery on March 1st for $2,400 is not completely satisfied with the outcome of the surgery. On March 5th, FYI allows a $400 reduction in the amount owed by the customer. So this is not a sales return. You can't take back what they did on your eyes. But we call this a sales allowance, and we credit the accounts receivable. Because, guys, do you see, we want to keep track of how the revenue was adjusted. So we show it as an allowance, but we reduce what they owe us by crediting our receivable. Any questions so far? You guys getting it? Students sometimes misclassify these contra revenue accounts, sales allowance, sales returns. These are contra revenue accounts that offset our revenues. Does that make sense? These contra revenue accounts, sales returns, and sales allowances are not expenses. They're contra accounts for the revenue. So when we have our revenues and then we see these contra accounts, it's going to create what we call net revenues. Like expenses, contra revenues have normal debit balances and ultimately reduce the reported amount of net income. Remember, contra revenues represent reductions of revenues, whereas expenses represent the separate cost of generating revenues. Know that these sales returns and sales allowances have a debit balance, but they're not expenses. Remember, we know it what an expense is because it has the word what after it? Expense. These are debit balances, but they are contra accounts against our revenues to help reduce our revenues to be net revenues. Okay? Sales discounts, reduction in the amount to be received from a credit customer if collection on account occurs within a specified period. What this means is the sale has already occurred. Everything's happened, but the seller's putting out a little tidbit saying, hey, if you pay your bill within, in this case, 10 days, I'm going to give you a 2% discount on what you owe. Discount terms in a sales discount shows 210 net 30. What that means, you get a 2% discount if you pay your bill in 10 days. Otherwise, you have to pay the whole amount within 30 days. Does that make sense? The shorthand way of the way we spell it out. It's a way to communicate the amount of the discount and the time period with when it's available. The term 210, pronounced 210, indicates the customer will receive a 2% discount if the amount owed is paid within 10 days. The term net 30, pronounced net 30, means that if the customer doesn't take that discount, the full payment is due within 30 days. Make sense? So let's say FYI provides laser surgery for $3,000. The company offers laser eye surgery in the month of March for only $2,400. FYI provides laser surgery to a customer on March 1st for $2,400 on account with terms 210 net 30. Now remember, they were offering it for $2,400, and remember this chick wasn't happy with the surgery, the outcome, and so she got the $400 discount. Do you remember that? So in this case, there's really only $2,000 left, right? That she owes. If she pays her bill within 10 days, it occurred March 1st. If she pays her bill within 10 days, she gets a 2% discount. You see, she paid her bill on March 10th. So she gets a 2% discount on $2,000, which is $40. Do you see how we record it? We show our cash for 98% of $2,000. We show a debit to a contra account called sales discounts for $40. But the entire accounts receivable of $2,000 gets credited because she doesn't owe any more, does she? She paid what she owed. Okay? This shows how these various contra accounts will show up on an income statement. Do you see? We have our revenue, service revenue and sales revenue. And then these contra accounts are subtracted from our revenues to come up with our net revenues. We'll subtract our sales returns. We'll subtract our sales allowances. And we'll subtract our sales discounts to come up with our net revenues. Make sense? Any questions so far? Now, you see here in our accounts receivable, we started with $2,400 of an accounts receivable. Then, if we have the $2,400 credit sale after the $600 discount, the $600 trade discount, we don't show anywhere. It's just like a sale. We show a credit sale of $200 here. We see that a customer returned those glasses for $200. We show a sales allowance of $400 because we gave them a discount because they weren't happy. And this shows the collection of the $1,960 plus the $40. We're going to credit the whole $2,000 because she doesn't owe us anymore. She satisfied her receivable. FYI typically provides laser surgery for $3,000. The company offers laser surgery in the month of March for only $2,400. FYI provides laser eye surgery to customers on March 1st for $2,400 with terms 210 net 30. Cash is collected from the customer on March 31st, which is not within the 10-day period. So there's no discount, is there? They're just going to debit the cash and credit the receivable and zero it out. Okay? Remember, guys, revenues are reported for the amount the company is entitled to receive. This amount equals total revenues minus trade discounts, sales returns, sales allowances, and sales discounts. Trade discounts reduce revenue directly. So trade discounts, think of like a sale. Okay? The sales returns, the sales allowances, and sales discounts get recorded in separate contra revenue accounts, and they're subtracted to arrive at our net revenues. Okay? The previous slides deal with how companies record contra revenues. However, companies also must adjust for certain amounts at the end of the year using adjusting journal entries. So revenue recognition standard requires a conservative approach. Companies are to report revenues equal to the amount of cash the company expects to receive. So in a perfect world, we should expect to receive 100% of those accounts receivable. But does it happen? No, it doesn't happen. Sometimes customers are unhappy with a product. We know all that. That's already in here. Sorry, that was already in here. So we're going to talk about how we need to be realistic on what we're actually going to receive in cash. We expect to receive 100%, but it's not going to happen. Guys, the effect of a sales allowance will result in which of the following? Is it an increase to net income, a decrease to net income, an increase to accounts receivable, or an increase to sales revenue? A B? Excellent. How about this one? Which of the following computations would be used to compute net revenue? See? Anybody else have an idea? A? Total revenue minus sales discounts minus sales allowances. Remember, revenue is the income. Accounts receivable is what? It's an asset. So accounts receivable isn't part of our revenues. The revenue is the sale providing a good and service, minus whatever sales discounts and sales allowances are involved. The accounts receivable shows what we are expected to receive because of selling products or goods. Okay? Okay. So again, here is an example of the revenue minus the sales discounts, the sales returns, and the sales allowances. Okay? Excuse me one sec. So let's look at a homework real quick before we get doing too much here. Okie doke. Let's look at chapter 5. Let's look at this. Who wants to take one of these scenarios? I'm not going to call on anyone, so you don't have to freak out. You don't have to keep your eyes off of me because I'm going to get eye contact with you. You guys can, speak it out. During 2024, IBM provides consulting services on its mainframe computer for $11,000 on account. The customer does not pay for those services until 2025. When would IBM record those revenues? 2024. How much will they record? $11,000. What about scenario 2? On January 1st, 2024, Gold Gems sells a 1-year membership for $1,200 cash. Normally, this type of membership would cost $1,600, but the company is offering a 25% New Year's resolution. What would they record? I thought I brought a Diet Coke in. Oh, yes, I did. How much would they record? 1,200? Y'all agree? Excellent. Next one. During 2024, the Manawak Company provides shipbuilding services to the U.S. Navy for $450,000. The U.S. Navy will pay $150,000 at the end of the year for the next 3 years, beginning in 2024. How much? 450? Are you sure? Yes. Scenario 4, during 2024, Goodyear sells tires to customers on account for $35,000. By the end of the year, collections total $30,000. At the end of 2025, it becomes apparent that the remaining $5,000 will never be collected. But what was the revenue? Do you guys understand what we're doing here? Does it make sense? Let's look at number 2 here. What we're supposed to do is record the necessary transactions here. Is this helpful to go through some of these? And those that choose to look at the lecture will see that they'll get their answers. So many times I get emails, please send me I need the answers. Well, you didn't look at the lecture. May 2nd. So what we have to do is the journal entry. Charlene books a fishing tour with Outdoor Expo for herself and 4 friends at the group discount price of $1,200. This was booked on May 2nd, and the tour is scheduled for May 7th. On May 2nd, what are we going to do? No entry. Why are we not going to do an entry? No events taken place, has it? So there's no entry here. Next, the fishing tour occurs. Outdoor Expo asks that the payment be made within 30 days of the tour and offers a 6% discount for payment within 15 days. What are we going to report as an entry? It happened. Didn't the event happen? So we show a service revenue as a credit. What's our debit? Accounts receivable of how much? $1,200, and we'll do our service revenue. Tour revenue, sorry. Tour revenue of $1,200. On May 9th, Charlene is upset that no one caught a single fish and asked management for a discount. Outdoor Expo has a strict policy of no discounts related to the numbers of fish caught. Is there a journal entry? Y'all want to see a good fishing story? Any of you guys fish? Okay. I love to fish. I just need to tell you, I absolutely love fishing. I have been married in my second marriage since 2000. I love my husband, but the one thing he doesn't do that I had in my first life was fishing. So I have a cousin that lives in Big Stone. Excuse me. I have a login with password. Oh, come on. Doesn't require the code. It'll be worth it. I promise. Okay. Come on. It's a real fish story. Labor Day, we're out on Big Stone. I caught my first walleye ever, 21 inches. Sorry, I just had to show you. I was so excited. I guess that's all I have. It was a thrill. Sorry. Getting back. It was a thrill. Those of you who fish, do you get what I'm saying? It was fun. Okay. So, she is not happy. She's upset. She didn't get her fish. What happens? No journal entry here. Next, upon deeper investigation, management of Outdoor Expo discovers that Charlene's tour was led by a new guide who did not take the group to some of the better fishing spots. In concession, management offers a sales allowance of 30% of the amount due. Now what do we do? Will we accord that adjustment? What do we debit? We debit sales allowance. 30% of $1,200 is what? $360, I heard somewhere. And what do we credit? Accounts receivable, right? Right? Oh, God. No. Accounts receivable. Tour revenue. Tour revenue is the revenue. And then these sales allowances are going to reduce our revenues, right? Next, Outdoor Expo receives the amount owed by Charlene. Remember, her fee is now down. $1,200 minus $360 is what? $840. And if she takes advantage of the discount, if she pays within 15 days, she gets a 6% discount, okay? So 840 times 6% is what? Come on, you guys have cell phones. 840 times 6%? $50.40. So our cash is going to be the 840 minus the 5040, $789.60. That's the cash. The sales discount is $50.40, and we credit the entire accounts receivable of $840 because she's satisfied the entire amount, hasn't she? Now they want us to show the transaction. Whoops. Requirement 2. So our total tour revenues are the $1,200 less the sales allowance of how much? $360. Not add, less sales allowances, less the sales discounts of $50.40, gives our net tour revenues $789.60. Do you see how we're showing our revenues? The full amount less the allowances, the discounts. Okay? Yes. We will. Less sales discounts. We will, sweetie. I don't know why it didn't do that. I'm sorry. I needed to put in that minus. I'm sorry. We will subtract it. Okay? Any questions on this? Okay. This next one, oh, well, we're going to move back to our PowerPoint. So now we're going to talk about valuing accounts receivable. This is where this chapter can be tricky, but trust me in this, okay? Hang in there with me. Not all of what we anticipate to receive are we going to receive. We recognize accounts receivables as assets in the balance sheet, and we're going to report them as what we're going to learn is called their net realizable value. This is the amount we expect to receive, okay? So, some account receivables are not going to get collected. Companies are required to estimate, based on past history, but estimate their future uncollectible accounts. And we record the estimates in the current year. Why do we do this? Remember, in accounting, we're supposed to match our revenues with our expenses. We match the revenues with the cost, with what it costs us to create those revenues. A piece of revenues are bad debts, meaning not everyone is going to pay. So we need to match, even though we won't know who's not going to pay right now because it happens in the future, but we need to estimate well enough so we match the bad debt expense with the revenues that should be offset with them. Does that make sense? So we need to come up with an estimated uncollectible account. What these estimated uncollectible accounts do, it will reduce our accounts receivable, what we're expecting to get in the future. And it's also going to create a bad debt expense, which offsets our revenues, right? So we're showing these revenues, but guys, we're not going to receive it all. So we need to estimate how much of that is going to be a bad debt expense in the current period in which we're recording the revenues. Does that make sense? Under this method that we call the allowance method, companies are required to estimate future uncollectible accounts and record those estimates in the current year. This will reduce our asset. It's going to go off against accounts receivable, and it's going to increase our expenses, bad debt expense. There's a couple ways we can do this. One way is called the percentage of receivables method. We base it on the estimate of bad debt expense on the balance sheet, which is the accounts receivable. So let's just say, based on their past experience, at the end of 2018, Kimsey is owed $20 million from customers. It estimates 30% of it's not going to be collected. So think about this, guys. We've got $20 million sitting as accounts receivable on the balance sheet. If 30% of that's not going to be collected, that's a lot of money, isn't it? We will show at that time a bad debt expense of $6 million. And we will create this contra account called allowance for uncollectible accounts, which offsets our accounts receivable of $6 million. Think about what this does. It reduces our net income ultimately of $6 million in the year in which we're showing those revenues, doesn't it? And we're also allowing for our accounts receivable to be realistic to what they should be, reduced by $6 million. So what happens is our bad debt expense is being recorded in the books, and we are allowing this contra asset account against accounts receivable to realistically show what we anticipate receiving in the future. Here, if we show credit sales of $50 million, our bad debt expense offsets those revenues to come up with realistic net income. So what's happening here, guys, if you think about it? Credit sales were $50 million throughout the year. At the very end of the year, out of that $50 million, we haven't seen 20 of it yet. Now, guys, you and I know we're not going to get all 20. They haven't paid by now. Chances are we're not going to get some. So we want to be realistic. We know in the next year we'll get a portion of it. We'll get $14 million, we're anticipating, but $6 million we're not going to get. But since those events are going to happen in the future, we know we need to be realistic in this year about our revenues and the expenses we're not going to see, or the bad debt we're not going to see. And we need to be realistic about our accounts receivable. We don't want to overstate what we anticipate we're going to get. Okay? That's why in the current period, instead of showing, oh, we have accounts receivable on our books of 20. No, we know we're not going to get it. So we adjust it now to show realistically we anticipate really only $14 million of accounts receivable. Guys, the truth is these are estimates. We're doing the best we can to estimate realistically where we stand. We will constantly adjust it, but we've got to come up with some form. And sometimes estimates are the best we can do. So, remember guys, adjusting the estimates of future uncollectible accounts matches our bad debt expense in the same period as the revenues they help to generate. Recording an allowance for uncollectible accounts correctly reports accounts receivable at what we call their net realizable value. Because allowance for uncollectible accounts has a normal credit balance, students sometimes think this is a liability, which also has a normal credit balance. Instead, this contra asset represents a reduction in the related asset account. Hey guys, what is one thing we know about liabilities? Apart from the account deferred revenue, what does a liability have in its name? Payable. So we know that allowance for uncollectible accounts is not a liability just because it's got a credit balance, because it doesn't have the word payable in it. It's a contra asset account against accounts receivable, which is an asset. What do you guys think of here? Which of the following is true regarding allowance for uncollectible accounts? It's a liability account? No. It is added to the total of sales discounts, sales returns, and sales allowances? No. It is subtracted from the balance of accounts receivable? Yes. It is a contra account to asset accounts receivable. Now, there's a couple ways we can determine what we expect our realistic allowance will be. There's another method called the aging method. The aging method takes what are receivables, and we break them down by those that are not yet due, those that are 1 to 60 days past due, 61 to 120, more than 120. Now we know the longer one goes out, the harder it's going to be to collect it, right? So what we do here is we show those that are not yet due. Based on history, we estimate 10% aren't going to be collected. But do you see those that are more than 170 days old? We estimate we're not going to collect 70% of those. So this is a more realistic approach. So we're going to come up with a total estimated uncollectible. As you see, it increases with the age it's outstanding. This means that the older accounts are more likely uncollectible, which is true. It's more accurate than just using a single percentage. So in this case, we would show a bad debt expense of $5 million, and we would credit our allowance for uncollectibles of $5 million. Okay? Which is the following is true about the aging method? D. Older accounts are less likely to get collected. So, now, we set this up at the beginning of the period. So when actual accounts in the future aren't collectible, it's not going to change our revenues and our assets in that current period. I'll show you how. When it becomes clear a specific account is uncollectible, the customer's not going to pay, we then need to write off that specific account. What we do when we write it off, we reduce the balance in the accounts receivable for that account. We're going to zero it out. But we're going to use this allowance for uncollectible accounts to offset it with. Ultimately, by doing this, it's not going to change our net accounts receivable because we have this allowance for uncollectible accounts set up for this exact purpose. The write-off, when we do this, has no effect on total assets or total expenses. Look what happens. Kimsey receives notice that Bruce Easley has filed for bankruptcy and isn't going to pay the $4,000. When we write off his account, we're going to debit this contra account called the allowance for uncollectibles of $4,000, and we credit his specific account for $4,000. So what we do is we decrease that contra asset account we set up, and we decrease his asset. But ultimately, because we have that accounts receivable along with that contra account, it's not going to change our net accounts receivable. It's just going to go from accounts receivable and get offset with the contra account. Remember, when we go and write off a particular account, we do not debit bad debt expense. We did the bad debt expense in the year in which we made those revenues. Now when we write off an account, we just debit the allowance for uncollectibles and we credit the accounts receivable. If later Bruce decides to pay $1,000 of the $4,000 he owes us, we reinstate the $1,000 he is going to pay us. So we debit the accounts receivable of $1,000, credit that allowance, and then take his cash and credit the receivable. In case he ends up being a miracle for 25% of it. When writing off an uncollectible account, total assets are unchanged. Okay? Let me give you an example here, guys. Let me go in here. Okay, let me just show you an example. Let's just say right now we currently show accounts receivable of $3,000, $30,000, and less our allowance for uncollectible accounts is sitting at $12,000. And our net accounts receivable is $18,000, okay? Okay, let's just make an example. And our buddy Bruce is not going to pay $4,000, okay? When Bruce decides not to pay $4,000, oops, I didn't want that. Okay. So this is our accounts receivable of 30. And this is our allowance for uncollectible of 12. Make sense? Okay, let's say Buddy Bruce decides he's not going to pay $4,000. Do you remember we debit allowance for uncollectible of 4 and we credit our accounts receivable for 4? Right? So that basically, we debit this for 4, we credit our receivable for 4. What does that make our new accounts receivable balance? $26,000. What does that make our new uncollectibles? 8. Come on. What is our, see it's the same amount? Do you see all we did is we took from one, we gave it to another? Right? Does that make sense? How I'm saying it doesn't affect anything? It doesn't affect the net number, okay? Moving back. Writing off a customer's account as uncollectible reduces the balance of accounts receivable, but also reduces the contra asset, allowance for uncollectible accounts. The net effect is that there is no change in the net receivable or in total assets. We recorded the decrease to assets as a result of the bad debt expense when we established the allowance. Okay? Now, here's the trick. This is the part that people get confused on, and just hang in there with me. Allowance method in the following year. Recall that when using the aging method, Kimsey estimated bad debts in 2023 to be $5 million. But what if they were really only $4 million? We're going to play catch up. In the next year, guys, all we can do is estimate what we know. But then what actually happens, happens. And sometimes we're going to go over, and sometimes we're going to go under. So if we thought they were going to be $5 million, but they really were only $4 million, in the next year we overestimated it by $1 million, didn't we? We had $1 million more of bad debt expense than we should have. So it's in the next year we're going to fix it. Okay? So in 23, we thought bad debts would be 5, but they were really only 4. But then in the next year, we're estimating bad debts to be $8 million. Well, because we overkilled it the previous year, we're going to make adjustments for it in the next year. So how does Kimsey record its $8 million estimate of future bad debts? Look at this. We thought it was going to be 5. It really was only 4. Do you see how we have $1 million left there? So in the next year, when we think it's going to be 8, don't forget this, guys. What we think is going to be 8 is the balance. Okay? We expect it to be 8. But don't we have $1 million sitting there? That's the key. Don't forget this. What's the adjustment we're going to make? It's not $8 million. It's only going to be $7 million. Because we overdid it in one year, we got to make adjustments in the next year. Okay? If there's one thing that gets students confused in this chapter, it's this. Students will say, oh, I need to show a bad debt expense of $8 million, and I need to credit my allowance for $8 million. No, you don't. That $8 million is what the allowance for uncollectibles needs to show as its total, not what the adjustment is. because we have to take into account, did we overkill it or underkill it? Does that make sense, what I'm kind of saying? So remember, when we say in 2024, here's what we anticipate our allowance to be, $8 million, that means that needs to be the bottom balance of the allowance for uncollectible accounts. And what we need to do is plug in the figure that gets us there. Okay? So in this example, what we're going to do, since we want $8 million to be the balance in the uncollectible accounts, we need to plug in. What do we need to do to get to $8 million? In this example, we only want a bad debt expense of $7 million and credit our allowance for $7 million, right? Because we overdid it the year before. Okay? Does that make sense? Now, and so you see, by doing that, our bad debt expense will show a bad debt expense of $7 million. But guys, in the allowance for uncollectibles, we want that bottom number to be $8 million because we had a surplus in there from the year before. But guys, here's another thought. Look at this one. What if we thought we were going to have $5 million in bad debts, but we actually had $6 million in 1 year? And then we're sitting with a $1 million debit balance in allowance for uncollectibles. But this year we want it to be $8 million. So guys, what did we do? We underestimated it. Do you see what I'm saying? We thought we would have $5 million of uncollectible accounts, but we actually had more. So in the next year, we need to catch up for what we underdid. Do you see, if this is the example, we would then show a bad debt expense of $9 million? Guys, this is the challenge. If you guys can remember that $8 million needs to be your balance, not what you're going to plug in, this chapter's a piece of cake. Where people get confused and screwed up is they think they're going to plug in the $8 million when in fact that $8 million is what we anticipate for this year. But to determine what our journal entry needs to be, we got to look and see where are we sitting in the balance. Okay? It's constantly playing catch up because we don't know for sure. We don't have a glass ball. Okay? Is that what, crystal ball? You know what I mean. When an entry is made to write off an uncollectible account, remember, we did this already. Total accounts receivable is unchanged. Okay? Let's go and look. Can we go look at one? Is this helpful? Okay, let's look here. We're going to record these transactions. Provide services to customers on account for $41,000. What's our debit? Accounts receivable. And what's our credit? Okay. Now, receive $25,000 from customers on account. We debit cash. We credit number 3. estimate that 45% of accounts receivable at the end of the year will not be received. This is our first year, so we don't have a balance sitting in our allowance, okay? So the first year is easy. It's the second year we have to be challenging. 45% of the accounts receivable. What are 41,000? We received 25,000. What's our net accounts receivable? 16? 16 times 45% is what? 7,200? So won't we debit bad debt expense of 7,200? Right? And we credit allowance for uncollectible accounts of 7,200. Right? Got me so far? Next. Provide services to customers on account for 56,000. So guys, this was 2024. Now we're in 2025. Okay? Provide customer services to customers on account 56,000. Accounts receivable 56,000. And what? Receive 10,000 from customers for services provided in 2024. Debit, cash, credit, write off the remaining amounts owed from services provided in 2024. So we started with 41. We collected 25, right? Then we collected another 25. So how much are we going to write off? We started with 41. We collected 25. Then we collected 10. That's 35, right? So how much isn't going to come in? 6,000. Remember, when we write off, we debit our allowance for uncollectible, right? Of how much? 6. We credit accounts receivable for 6, right? Now we receive 45,000 from customers for services provided in 2025. What do? Cash, credit, estimate that 45% of accounts receivable at the end of the year will not be received. Okay, here's the trick. In 25, we had sales of 56,000, didn't we? Right? We collected 45. What's left? 11. If we think 45% of that 11,000 isn't going to be collected, what do we want our allowance for uncollectible accounts to be? $49.50. Okay? We want that bottom number to be $49.50, don't we? But guys, we already have a balance sitting in there. That's our challenge. So for example, we started our allowance of uncollectible, wasn't it 7,200? Remember that? Do you remember we wrote off 6,000? Do you see we have 1,200 sitting here? But in the next year, we want this to be what? 4,950. So what do we need to credit to make it 4,950? I'm sorry? 3750. Do you guys see what I'm doing? That is the key. This is where people get screwed up. They think the 4,950 needs to be the journal entry. No. That needs to be your balance. So we want our journal entry to be 3750, guys. So 3750 here, excuse me, where am I going? Oh, wrong one. We want 3750. Shoot, where am I? I am 3, aren't I? Thank you, guys. So we want 30. What am I doing wrong? Thank you. We want this to be 3750. Don't we debit bad debt expense of 3750? And we credit our allowance for uncollectibles of 3750 because we wanted that bottom number to be our 49 whatever. Okay? Any questions? Yes? No? Guys, remember, if there's one thing you remember in this class today, for the second year and further and on, when we estimate our allowance for uncollectibles, that's what we want the new balance to be, not what the journal entry is. Okay? If you can remember that, you got this easy. Okay? After this, we then will go and take all those journal entries and post them to these accounts. Okay? Pretty straightforward. Then from there, you'll see, calculate the net accounts receivable reported in the balance sheet in 24 and 25. You'll have your accounts receivable minus your allowance for uncollectible accounts. Okay? In this one, remember we talked about the aging method is usually probably the best. Calculate the allowance for uncollectible accounts. 40,000, that's not yet due at 4% is how much? 1,600? $16,000 at 20%, 3,200. 11,000 at 25% is what, guys? 25, 27, thank you. 80% of 13,000? What do y'all think? I'm sorry. 1040? 10,040 or 10,400? 10,400. Does that make sense what we're doing here, guys? On July 19th, 2025, a customer's account balance of $8,000 is written off as uncollectible. Record the write-off. How would we do that? We would debit allowance, credit the account, right? now it's asking me record the December 31st, 2024 adjusting entry, assuming the balance of allowance for uncollectible accounts before adjustment is a $5,000 credit. So if it's sitting as a $5,000 credit, whatever we came up with here, $17,950, we have to remember there's a $5,000 credit up there, right? So we'll only make our journal entry $12,950. Does that make sense, guys? That's the key. You can't forget that. Okay? Moving on. Now, the allowance method is generally accepted accounting principles. The direct write-off method's a piece of cake. The direct write-off method doesn't follow GAAP because it writes accounts off in the year after the sale occurred. The direct write-off method just writes off the account. We don't do an allowance. So unlike the allowance method, which requires estimating the uncollectibles, the direct write-off method just writes bad debts off at the time they're really uncollectible. What? The debit is bad debt expense. The credit is accounts receivable. We don't technically use it for GAAP purposes because we're not matching our revenues with our expenses. So what happens is comparing the allowance method to the direct write-off method. With the allowance method, we have to estimate. With the direct write-off method, we just write them off in the year in which they become uncollectible. Easy. Okay? Some students think firms should reduce total assets and record bad debt expense at the time the bad debt actually occurs. Remember, we are anticipating by creating an estimate future bad debts, and that's why we establish an allowance account. The direct write-off method reduces accounts receivable and records a bad debt expense at the time the accounts receivable is uncollectible. If the credit sale occurs in a prior recording period, the bad debt expense is not properly matched with the revenues. Also, in the previous year, our accounts receivable are overstated, right? Who wants to take this one? On December 31st, before adjusting entries, a company's balance for allowance for uncollectible accounts is a credit of $2,000. What does a credit balance prior to adjusting entries indicate? It was too high. Last year's estimate of bad debt expense was too high. Guys, we're always going to be playing catch up though. We don't know. We're doing the best we can. What about this one? On December 31st, before adjusting entries, a company reports the following balances. The accounts receivable was $100,000 debit. The allowance for uncollectibles was a $2,000 credit. The company estimates bad debts to be 20% of accounts receivable. The adjusting entry would include what, guys? How many agree with A? Are you sure? Are you positive? Excellent. Remember, we need to know what that credit is. If we want that balance in the allowance of uncollectibles to be $20,000, we want that balance to be 20. We need to see there's a $2,000 already sitting in there. So we're going to debit bad debt expense of $18,000. and credit our allowance to be $18,000, right? Now, notes receivable have a written agreement. No, you will always have a signed written agreement when you have a note receivable. It will show the date the event occurred, the amount, the due date, the interest, the maker, and the payee. Okay? No, if Kimsey provided $10,000 of services to Justin Payne, who is not able to pay immediately, Justin signs a promissory note offering to pay $10,000 plus 12% interest in 6 months. Initially, on August 1st, the note receivable was put into place, okay? But then for February 1st, on February 1st, the note receivable happens. Then in August, when it's going to be paid, at that time we will show the interest receivable, okay? No interest gets recorded when it initially is taken out. We just show the note. Notes are similar to accounts receivable, except oftentimes they have interest attached. In 6 months, it's at that time we will show our interest revenue, the note we received, and the pure cash. Okay? The full amount of cash. Okay? Remember, we calculate interest based on an annual interest rate. In this case, the annual interest rate is 12% or 1% a month. Know that if at the end of the year interest has accrued, we will need to show that in the books. So say, for example, so know that if Kimsey was going to pay the note on May 1st, but it's the end of December, the financial statements need to be finished. We will need to show those 2 months of interest that was accrued in the previous year. We'll need to show that amount on the books as interest receivable and show that as interest revenue. Okay? So in this case, if the note was taken out on November 1st, by December 31st, we will need to show $200 of interest receivable, and we credit our revenue. We've earned it even though we haven't received it yet. Then in May, when we get paid, note, we will show that $200 from interest receivable in 2024 is now being paid off. Does that make sense? So when it goes over 2 years, we'll have a receivable at the end of that 1 year, and we'll have to adjust for that. Okay? A company accepts a note receivable of $5,000 on September 1st that matures in 10 months and has a stated interest rate of 6%. What amount of interest revenue will the company record in 2024 and 2025? Anything? September. So at the end of December, how many months? All of September, all of October, all of November, all of December. 4 months. 5,000 times 6% divided by 12 months times 4 is what? 100. And then for 6 months the next year,
Isn't it like 4/10?
4/12.
Because it's only 10.
But interest rates is over 12 months. Okay? Remember, when we say 6% interest, that's over 12 months. So we have to take our 5,000 times 6%, divide that by 12 months to figure out how much it is a month. Okay? So if it's 100, how much is it in 2025? 150. Does that make sense, guys?
But then the total is only 250, not 300.
Correct. Because remember, when we say a stated interest rate of 6%, that 6% interest rate is calculated over a 12-month period. Okay? So the entire amount is 5,000 times 6% times 10/12. Okay? So only 10 months out of a year. Got it? And stated interest rates is always termed, recorded for a year at a time. Okay? Next, key ratios. I'm going to let you do this piece on your own. In Chapter 12, we will be going over all of these ratios. So I want you to be aware of the receivables turnover ratio, the average collection period, and compare what is favorable and what is not favorable. No, it just helps understand how management's doing in collecting money. Okay? You will have questions on that, so you want to utilize that. Now, the last piece is the percentage of credit sales method. Know that the allowance method is what you're going to really focus on, but there is another way of showing allowance for uncollectibles called the percentage of credit sales method. The percentage of credit sales method estimates uncollectible accounts based on the percentage of credit sales. We also call this the income statement method. Okay? We adjust the allowance for uncollectible accounts for the current year's credit sales that we don't expect to collect. So no, at the end of 2024, if Kimsey has accounts receivable of $30 million, with a credit balance in their allowance for uncollectibles of $1 million, and we see credit sales of $80 million. Under the percentage of receivables method, we will estimate $8 million of ending accounts receivable to be uncollectible. Okay? Under the percentage of credit sales method, we just estimate 12.5% of credit sales are going to be uncollectible. So under this percentage of credit sales method, we will just take 12.5% of 80 million in credit sales, gives us our 10 million. When you use the credit sales method, you don't care about this existing balance sitting in the allowance count. The reason under the receivables method we care is because that receivables method gets tied directly against our accounts receivable. When we're using the credit sales method, we just go off of sales. We don't care about what's sitting in receivables. accounts receivable, percentage of receivables method is more common. Okay. No, under the credit sales method, you see here, we aren't interested in knowing what that allowance for uncollectibles is in the end. We're going to come up with different amounts here, but ultimately it's all going to end up being the same. Just a timing difference. Check your understanding. On December 31st, before adjusting entries, a company reports the following balances. The company estimates bad debts to be 4% of credit sales. The adjusting entry would be what? If it's credit sales, it's going to be D. Okay? Credit sales, we don't care about our ending balance. We're going to take 4% of our credit sales, $500,000. Okay? It's being based off of sales called the income statement method. The allowance for uncollectibles or the balance sheet method is we are looking at our accounts receivable and basing our uncollectibles off of that. So let's, how are you doing? Do you want to go through any other problems? Are we good? We're good? Okay. I will end this slide and